Good morning, everybody, and welcome to today's meeting of the Local Pension Committee. As usual, this meeting is being broadcast live via the County Council website, and it will be also available for viewing after the meeting. I have received apologies from Mr. Dean Gamble and Mr. Zubair Limbada and also Nick Booth. So the first item on the agenda is the minutes of the meeting held on the 21st of January 2022. I propose that the minutes of the meeting held on the 21st of January are taken as read, confirmed and signed. Is that agreed? Thank you. Item 2 is question time. I've received no questions from the public. Questions asked by members under Standing Orders 7.3 and 7.5. I have received no questions from members. I am not aware of any urgent items. We'll take that to item 4. Item 5 is declaration of interest in respect of items on the agenda. Does any member have any interest that they wish to declare? No, thanks very much. Presentation of petitions under Standing Order 35. I am not aware of any petitions received. So on to item 7, which is the 2022 fund valuation result of the stabilised employer modelling. Ian Howe, Pension Manager, will introduce this report. We're also joined by Richard and Tom from the Fund Actuary, Hymans Robertson. So over to you then, Ian.
Thank you, Chair. Morning, everybody. Just to say, Tom and Richard are joining us, as I say, for this item, but they will be leaving after this item. Thank you for the presentation from Tom and Richard in terms of the training earlier. That was helpful in terms of setting the scene, but if I can briefly just cover some of those points again for the benefit of the meeting. So every 3 years we have to do a fund valuation, and that effectively sets the fund value. It's to ensure that the fund value is on track, but it also sets the employer contribution rates. The next fund valuation is the 31st of March 22, so in a week or so's time. The rates for the employers are then set from that, and that sets the rates from the 1st of April 23 to the 31st of March 26. We have only looked at this stage at the stabilised employers. The stabilised employers are the larger employers generally, and they tend to be the tax raising bodies. That's the county, Rutland, city, the boroughs and the districts, and police and fire. I don't propose to go through every point in the report, but I will pick out the key points in here, if that's okay. The 14-year deficit recovery period is one of the key points to note here. At the previous valuation, we used a 17-year deficit recovery period, but we have brought that in 3 years to try and pay the debt off more quickly. We used 5,000 economic scenarios for modelling the rates, as Tom and Richard have mentioned, and it's in the slides, which is in the pack. We did that using 3 different scenarios. One of them was to freeze the employer's contribution rates at the 22-23 value until 2026. One was to step down 1% per annum on the 22-23 rate, and one was to increase 1% per annum on the 22-23%. We set a likelihood target of 75% in terms of achieving the modelling. So as Tom and Richard have said earlier, 75% of those 5,000 economic scenarios need to meet that 75% test in order for that prudence test to be achieved. There are risks, and I'm sure you're already aware of them, and we're classifying them as the 4 C's: climate change, COVID, the consumer price index, and unfortunate conflict in Ukraine. But we're confident that the modelling has been done with enough of a sort of a stress test built in there to give assurance that we're comfortable as officers that there's enough prudence in place in place there. If I may jump ahead really just to briefly touch on the Government Actuaries Department, the GAD 13 report. This isn't actually directly linked, but it is something I did wish to mention. The Government Actuaries Department have been looking at the results across all of the funds and using that to do a kind of a comparison to ensure that any outlying funds or any risks that funds may have are being highlighted at a national level. And there were some kind of flags that they used to determine any risks. I am pleased to say the Leicestershire Fund got green flags in all areas, which indicates there are no material issues and no remedy required. But what it did also highlight is we are actually kind of lower in some of the areas than other funds. We're in kind of the bottom half of the results. So that just means that we need to be aware of that and to ensure that we don't lose sight of that, and we need to just ensure that we keep that level of prudence there. So it's good, but I just think it's a very slight warning we just need to be aware of. Another area I just wanted to briefly touch on before I get into the key point, which is really looking at the results, is the administrative costs. There's 0.3% built into the rates to cover administration. We've managed to keep it at 0.3 for the last 6 years of the last two valuations, but there are some significant national projects and pressures building on pensions administration. The two key ones are McLeod, which I know we've talked about before at previous committees, and indeed dashboards, which is the new national project whereby all people within the UK will be able to view all their pension benefits through one dashboard. They're significant projects in themselves, so that requires us, or we would like to propose, an increase of 0.1% in terms of helping the administrative costs. So that would be an increase from 0.3 to 0.4%, or a 0.1% increase on the rates. Now the key part really within the report is the points, the indicative report results in points 34 down to 36. So in point 34, when we modelled the outcomes with the 75% likelihood of being fully funded in the 14 years, using a freeze on contribution rates, 3 of the employers exceeded the 75% test. And as detailed in the appendix, that's the City Council, the police and the fire. All the other stabilised employers, bar ODB, fell under the freeze scenario, just below the 75%, but with a 1% increase in year 1, but no increases in years 2 and 3, they reached an acceptable position with officers and the actuary. Only unfortunately OB still fell outside of that, but with a 1.5% increase in year 1 and no increases in years 2 and 3. Again, officers feel that that's an acceptable position, and that's been discussed with the actuaries. We are aware of the financial pressures that employers are under, and we do need to balance that against the long-term financial stability of the fund. So we feel as officers and the actuaries that's a fair outcome for the employers and also the fund themselves. I've updated the timeline, which I won't discuss in any length. I've updated the timeline to show where we're currently at. The next stage will be to discuss these results, if indeed agreed by committee, with the employers, and then we'll move ahead into the next stages, which is the assumptions and then modelling the other employers within the fund themselves. That's all I propose to say in terms of a report, but obviously I'm happy to take any questions.
Thank you very much, Ian, for a comprehensive explanation. Has anybody got any questions? Keith.
Thank you, Chair. Just a little bit of clarification, please, on the increase in administration costs to 0.4%. Is it the figures in paragraph 33? Are they the actual costs for the administration? 2.7 million administration fees in paragraph 33.
It's very close to that. Yeah, it's we've got the report about the budget actually coming up, yeah. So we can kind of go through that. It is around about that value though.
Okay, I don't work on a roundabout, so I like to know exact figures. So I think it would be helpful to us if paragraph 32, if you're shown an increase to 0.4%, which is a 0.1% rise, to give us that in actual cash costs.
Okay,
please, because I don't know if that's good, bad, or indifferent.
It's good in terms of comparison against other funds. We still believe that is good value for money and efficient. It's actually lower as a percentage than a number of the other funds in comparison to us. But
so again, if you're comparing it to other funds, show that comparison in the report so we can see that it's good, because you're comparing it to other funds. Because there's a lot of ifs there for me, sure. And I can't make a decision to say whether it's good, bad, or indifferent.
Okay, point taken. Thank you.
Okay, thank you.
Thank you.
Ashley.
Yeah, a few years ago, contributing bodies could pay like 3 years in advance on contributions, and it led to them making a saving on the contribution. Is that still possible, or is that ruled out now?
Yeah, you're absolutely right, Mr. Wilson. You are. At the last valuation, we had at least one employer that paid a higher rate in year one. They effectively front-loaded their secondary contribution. I'd be willing to have those conversations with any employers that could potentially or wanted to consider doing that, to front-load the secondary rates into year one to reduce the cash values in years 2 and 3, if that was helpful, certainly.
Okay, so has anyone else got any further questions? Not. So taking on board Mr. Murray's points, we are asked to note the proposed changes to the stabilised employer contribution rates from the 1st of April 23 to the 31st of March 2026, subject to there being no material changes, that discussions are due to be held with stabilised employers regarding the proposed rates from the 1st of April 23 to those to the 31st of March 2026, and see the expected increase in administration charge by 0.1% from 0.3 to 0.4% from the 1st of April 2023 to the 31st of March 2026. Is that agreed? Yep. Okay, so that's unanimous. Thank you. The next item is the Ifm Markets update. For this item, we have Phelim Bolger and Harry Wang with us from Ifm, who will present to us on this item. At least I hope we have. Bulash, if you would introduce.
Do we normally just do this bit first, and then get them in? Okay. Fine.
Morning, everyone. Good morning. Just take a seat down there. So,
whilst they set up, I'll correct.
Yeah. Okay. Thank you. Thank you, Bulash.
So we've got a short presentation from Ifm, which are one of our infrastructure managers. They're one of 6 managers that we have on our portfolio for infrastructure alongside LGPS Central. We do have a target allocation of 9.75% to infrastructure within the fund. We are underweight that, have been for a while, by about 2.4%. There is an infrastructure review planned for later this year as a result of the 2022 SAA proposals, which were approved in January. It will then help us understand how to utilise LGPS central products, how best to close the gap to that target allocation. This Ifm presentation should cover off, similar to previous manager presentations, an overview of the mandate, ESG, so how the manager identifies and manages and what policies in place, the performance of the fund, and then finally an outlook on infrastructure investment. As at the 31st of December, the infrastructure valuation for this product from Ifm was 125 million. It's the second biggest allocation we have in our portfolio. Kindly hand over to Felim and Harry.
Yeah, if you could just press the middle.
There we are. So
They'll only do one at a time.
We'll do one at a time. So first and foremost, thank you very, very much for allowing us to be here this morning. We haven't seen you in a while, so it's great to be able to be here in person as well. Great to see that we're able to do that. Also, we've put together very much on Bhulesh's direction an agenda that, as he said, should map onto what you're familiar with. By way of introduction, my name is Phelan Bolger. I'm responsible for our institutional business and our local government relationships here in the UK. And I'm joined by my colleague Harry Wang, who's relationship manager for the LCC account with us. So we'll talk about the overview of the mandate, the ESG, the performance and the market outlook, and we'll share the presentation between us so you don't have too much of one voice, and I'll hand over to Harry to start off.
Thank you, everyone. So just as Phelan was saying, we'll start off with a quick summary to kick us off. A few key points, starting with slide 3, that we think will sort of permeate through today's discussion and presentation. Just picking up on those few points, Ifm continues to have a unique ownership model with shareholders comprising of Australia's largest superannuation funds. We continue to believe that alignment between our shareholders and the underlying investors in the fund, being predominantly pension fund capital, allows us to seek synergies and to further support the key stakeholders we have. In terms of the fund itself, Ifm pioneered back in 2004 the concept of the open-ended structure for this fund, and we believe that has been very successful over the years in terms of managing, operating and acquiring long-term dated assets, in this case, of course, infrastructure. The fund has grown as at end of December to USD 41 billion. That makes it the largest fund of its type in the industry, and it's supported by one of the largest infrastructure teams as well in the industry. Just a couple of final points to this slide before we flip over. Firstly, the fund has had a proven track record, generating 9.2% net per annum since its inception back in 2004. And we'll go into the performance slightly more later on in the presentation. And secondly, as well, as you may have seen recently, we have announced a net zero commitment across all asset classes by 2050. That includes also a 40% reduction to carbon across infrastructure by 2030. And we'll go into, as Bhulesh and Phelan has mentioned, the ESG aspects of that in more detail shortly in the presentation as well. So turning to slide 4, as mentioned, Ifm has a unique ownership model of large Australian superannuation funds, which brings that alignment between our owners and also underlying investors such as yourselves, being pension fund capital. In Australia, that model allows Ifm to operate very much like a pool. Outside of Australia here, the key focus is on infrastructure equity and infrastructure debt, being the two primary offerings that we have. Furthermore to that, as you see on the slide, the bottom right, this again just captures that overall capital makeup of the investors in the fund, being predominantly pension fund capital. At this point, I'd like to mention, of course, Leicestershire being the first investor in Europe for us into this fund, and we very much thank you for your support since 2011, since that initial commitment. Since then, by June this year, we will project that total LGPS commitments in the fund will reach around 3 billion USD. Turning over to slide 6, just some key terms of the mandate, serving as a bit of a reminder, but just as a summary as well, the return target for the fund has remained consistent since its inception, being 10% per annum net after fees and expenses, and that will move between 8 to 12% depending on where we are in the market cycle. In terms of the management fees, since Leicestershire's initial commitment back in 2011, we've managed to secure an aggregation of all LGPS commitments in the fund to be seen as effectively one entity for management fee purposes, and that's brought down the fees from where it normally would be, which is 77 basis points to 65 basis points. So that's benefited all the LGPS investors currently in the fund. Other points to make on this particular slide, as mentioned earlier, the fund continues to be open-ended, and that is, of course, the thesis going forward. Valuations of the fund are done on a quarterly basis, done by independent valuers for each of the underlying portfolio companies. Slide 7, before I turn back to Phelim, just a very quick overview of the geographical location of all these portfolio companies. As you see on the slide, predominantly being in the Americas and in Europe. 2021, I should say, has been a very busy year for us, and indeed so far in 2022 as well, in terms of acquiring new portfolio companies. In 2021, we acquired Enwave, which is a Canadian business, and also Naturgy, which is based in Spain. And so far this year, we've acquired Glasfaser Plus, based in Germany, and also Sydney Airport, which is of course in Australia. And we'll be going into more details shortly as well. We continue to add and diligence quality assets of this nature, which we believe add accretive value to the fund. And with that, I will pass to Phelim to talk more about the strategy.
We thought it would be helpful to do a quick recap of what it is that we do and what it is that we invest in. As an infrastructure fund, our focus, and I think it's fair to say every infrastructure manager will have their own lens that they look through. So our focus is very much on utilities, on energy and the transportation sectors. And we put down the subsectors that sit below that. For us, what's really, really important is that infrastructure that gets put into the real asset bucket, but these are our real operating businesses. And as a consequence, we really review each and every one of these as being very unique. So you can't just look at them on a sectorial basis. You need to have that extra lens of diligence that goes over these particular businesses. So we're looking for businesses that we would term as dominant market positions, businesses that have some unique characteristic. To give you an example, one of the investments that we have in the portfolio is Dansk Port on the Baltic Sea. It is the only deep sea year-round ice-free port on the Baltic Sea, so it has that unique characteristic. We're an open-ended fund, so we want to use that open-ended fund to have long asset lives for our assets and to be able to be a responsible investor over those lives to deliver value. We look for inflation protection, certainly something topical at the moment. We do want to have some GDP exposure. We want to benefit from growth, but with those very dominant and essential business as part of that, have those stable revenues, and we'll touch on that a little bit more later, be it in regulatory environments where there's stability and good rule of law, and finally sitting behind each and every one of the companies that we have, that the financing that sits behind them is investment grade, and also that financing and leverage level that we put in the portfolios is low on a relative basis. What we're trying to do with the businesses is fundamentally, and the portfolio is fundamentally, pretty simple, but a lot of work that sits behind it. We're looking to buy well. We're looking to manage those assets effectively and intensively. And from time to time, we might sell a piece or all of those assets on an opportunistic basis, generally on a reverse inquiry basis, but where it makes fiduciary sense from a portfolio management perspective. So when we're looking to buy assets, we're looking to partner with other like-minded long-term investors, in very many cases within the public sector or the semi-state sector. We're using the fact that we've got one of the largest teams in the industry to support that sourcing. And we're also looking within the portfolio at how can we buy smaller businesses maybe within some of our portfolio companies. So we're buying for the fund, and we're also buying at the portfolio company level, so some smaller accretive opportunities. So a constant process that's going on. The intensive management really means that we're buying businesses that matter to communities and societies. Our job is to continually invest in those businesses to ensure that they can deliver the services, remain essential, and of course face up to some of the challenges that are going to exist potentially in the future through climate change. So for us, ESG is an important risk management tool, but also an important way of ultimately what our job is as we view it, as a way of de-risking the future cash flows that infrastructure should be delivering to our investors. So that's really our focus when we're managing these portfolios, using the governance and control that we have to implement those plans. As I said, from time to time, we may sell an asset, and we've done a partial sale recently, which has had a positive impact on performance for you and on our investors, and we might touch on that later if we have time. We wanted to give you a view of the diversification of the portfolio. So slide 10 touches on the top down, and the top down is kind of the classic, as you can see on the left-hand side, by portfolio company. You can see the different by sector. So you can see the different portfolio sectors that we have within the Global Infrastructure Fund. So you can see that diversification. The colour is going to stand out quite well there. So you can see the diversification in the different sectors and subsectors that we're in. You can see on the top right-hand side, you can see the various different companies that we're allocated to. And these portfolio companies, some of them are single asset companies, but most of them are platforms. So by that, we just mean businesses with a large operating footprint and maybe some sub-businesses that exist within those related to the purpose that they have. And then finally, you can see the geographical breakdown on the bottom right-hand side of the slide. So again, just giving you that diversification indication. Slide 11, though, is taking that diversification in a slightly different way. And it's looking at what we think is probably the most fundamentally important part of the portfolio. It's looking at how each of those businesses make money and the way that their revenues are generated. And we divide it into these 4 different sectors. Contracted, which is fairly obvious. We're looking for contracts, basically contracted-based revenues, and we're looking for long-dated contracts, secure contracts, and contracts with good counterparties. We'll operate under various different types of regulation in various different countries. We have a category that we call patronage and market categories, and they kind of fall into the economic exposure. But patronage is where basically we take some demand risk, but we don't take price risk. So we'll have some form of so we say, a regulated price mechanism, but variability in demand. That's an important tool in our inflation protection. And then market risk is where you're taking a little bit more of both demand and price risk, but you're doing so in a very controlled manner due to the essential nature of the business that you have. And as you can see from the pictures on the right-hand side, a number of the businesses actually have quite a few different cash flows. So sitting behind everything that we do in the Global Infrastructure Fund is a portfolio management system that allows us to disaggregate everything the businesses are doing and then re-aggregate them so we can manage the portfolio effectively. And within the 110 members of the investment team, 7 members of the investment team are dedicated purely to this aspect of the portfolio, managing the diversification, managing and understanding those cash flows, and also managing our various different hedging programs. Without wanting to hark on about it too much, but slide 12 is just to give that diversification another cut and perhaps to make it just a little bit more human. Across the Global Infrastructure Fund, we're actually employing more than 47,000 people. So it's an enormous responsibility that we have as we operate through the various different boards that we operate. We are operating in more than 20 countries, principally in 20 countries, but then with a tail of various other countries that our businesses have small operations in. And our average investment size is about 1.4 billion, but that does vary from small acquisitions, as I said, within the portfolio companies, through to some larger businesses. And you can see 5.3 gigawatts of renewable, you can see the 9 port facilities, the toll roads, the various different other things that we do. So the physical tangibility of what it is that we're up to. And then the final piece of this section, just to really recap and bring you back up to date on the Global Infrastructure Fund, is just how the portfolio has developed over time. And I think what we would draw out from this slide or share with you in this slide is that there has been continual growth, continual acquisitions, some sales along the way, but it's been done on a very measured basis. So we don't have a desire to go out and open the checkbook and buy another business for the sake of buying a business. Everything that we want to bring into the portfolio, we want to bring in on an accretive basis. Harry said earlier that the portfolio's objective is 8 to 12 over the market cycle, so a base 10. So we're always looking to bring in a business that meets that 8 to 12 objective, but also where we can add value and where they have those other characteristics that we discussed earlier on, those kind of extra levels of infrastructure-like protection. And as Harry mentioned, the activity that you see post-COVID, a lot of work done during COVID focusing on, of course, the health and safety of workers and the provision of essential services, but it didn't stop us continuing to research opportunities. And once we could get back out and kind of kick the tires and actually physically get on site with various different opportunities that we've been researching, you've seen some activity in the portfolio over the course of the past 9 to 10 months, kind of a culmination of work that we've done over the previous 24 months. So I'll pause there. That's kind of the recap of the portfolio before Harry leads us into ESG, but very, very happy to take questions.
Has anybody got any questions they'd like to raise at this point? Yeah, please, Mr. Lawrence.
I think it's a really, really good question, and you know, I think candidly one of the areas that can be, perhaps we can communicate better, and we will do so a little bit more, is actually how we think about the assets that we have, because at the end of the day, essential infrastructure builds upon what has fundamentally been a carbon-based society that we've had for an incredibly long period of time. I think if we think about something like a toll road itself is non-carbon producing. It's an existing piece of infrastructure. So our job is first and foremost to maintain it well, to ensure that you maintain the health and safety of staff, etc., etc. We also think about what we can do about LEDs, about service stations, about the lighting, obviously changing the lighting, reducing energy emissions. So what you're looking to do is reduce as much energy emission as you can have in the maintenance of the road. But also we can see that we'll be a net beneficiary of electric and hydrogen vehicles. So that aspect, for example, is something that we'll be very kind of focused on. Actually, we can see a future pathway where our asset is actually, from Scope 1 and Scope 2 point of view, very low emitting, and then we'll be a benefit of technology. With regards to the pipelines themselves, how we kind of view a couple of things. One of the things with the pipelines is they themselves use a reasonable amount of energy. So one of the big things that we're doing with our pipelines is that we're basically renewabilizing the whole of our pipeline businesses. So we're putting renewables behind the meter, i.e. into the businesses. So our pipeline businesses will actually be able to produce 2 times the amount of energy that they need from a pumping point of view in the next 2 years. So they themselves, as a business, will become carbon neutral. Now, obviously, what runs through the pipes has carbon, of course, or the distillates going through those. But what we're looking to do is support a transition. So as a responsible owner, clearly distillates are still necessary, but how can we support a move to gas, investing in the pipes to be able to facilitate that transition towards gas? And also we bought those businesses with a view to obsolescence. So we didn't buy those businesses with a view that they would be around necessarily forever in their current format. So what can we do to transition those businesses, maybe through gas, maybe in the future through hydrogen, obviously using them as renewable platforms. And then from a marine terminal point of view, again, one of the big things that we're doing with our marine terminals is changing and beginning the change to biofuel. So working with the businesses that we have and with our co-shareholders on moving towards biodiesel and biomethane. So that's an investment process that we have at the moment. And maybe finally, with regards to the airports, actually Manchester Airports Group, which was the first as an operating platform carbon neutral airport group in the country. Obviously what's landing on it isn't carbon neutral. We've done a lot of things, for example, on Manchester Airport itself to improve taxiing. So we spent a lot of money, and part of that was to improve taxiing. So basically to reduce emissions of planes on the ground, also looking to reduce things like noise emissions, etc., etc. We have worked with the government and with all the airlines on what's called the Sustainable Aviation Alliance and the Jet Zero Council. Manchester Airports Group has just installed a biofuel terminal. So we're beginning to put some biofuels in some of the planes. So actually working with the airlines and the airline industry as a whole, we also have a path for carbon reduction within those, because we still need to be able to support that transport until that next generation of futuristic planes might come along. But we're definitely investing in ways of reducing the carbon intensity of what we're doing. So that 40% goal that we have, we have the longer term 2050 aspiration, but the shorter term 2030 goal is to be able to say to investors like yourselves, we're doing something really tangible in the shorter term to take 40% of the greenhouse gas emissions out of the portfolio minimum over the next 8 years through some of these sorts of initiatives.
Thanks very much, Phelim. A fairly clear explanation there. Thank you.
You're very welcome.
Sue.
Thank you very much, Chair, and thank you very much for the presentation. we're obviously going to come back to the issues raised in the next section of your report, but I wanted to ask about the percentage of the investments that relate to the United States of America, which is over 41%. Is that a trend that you expect to continue? And why are such a significant amount of the investment put into the United States? Thank you.
So, interestingly, actually, the United States doesn't have a huge amount of infrastructure to buy on the private markets. It's actually, as a country, suffering from an infrastructure deficit. If you were to go back and look at our pie chart, probably 3.5 years ago, the US would have been significantly less. And actually, if you look at the pie chart when we send you the report, your June report, it will have gone down again. I think one of the things with infrastructure when you're building a portfolio, we have this focus on OECD, on North America and Europe, but there are times that a particular asset might come up in a region and it makes sense to go for that particular asset. So the most recent acquisition that we had in America was a business called Buckeye, which is one of the ones I was just talking about with your colleague, which is a business in a midstream business that we have in America. So when you put that and our Indiana Toll Road together, it is two large businesses in the US. We are very comfortable with the US as a region. Obviously, it's got good rule of law, and because it's got relatively limited infrastructure on the private markets, there is a good, so we say, secondary demand for what we have. We look to invest or to divest. But what we have done since is the transactions that we've done. Okay, Canada is North America, but it is Canada. We've diversified there. Large investments predominantly in Spain with Naturgy. And then what isn't in our pie chart at the moment is our new German investment in fibre, and then our new Australian investment. So you'll see that diversification coming on. And then we have a focus at the moment on a particular transaction, which again is going to be happening in Europe. So you'll see that sort of allocation to the US, I think, contract over a period of time. It may then re-expand a little, but generally speaking, we will probably in or around the 30-40% of the US, because it is a good market with a good footprint, and also a lot of focus now with the Biden administration on sort of renewabilizing their businesses, which is something that kind of feeds well into what we're doing on our particular investments.
Thank you. So have we got any other questions? Yeah, Keith.
It's not so much a question, Chair, but first of all, great presentation, very clear and concise, and I like the way it's been presented. A picture paints 1,000 words, and there's more pictures on the slides than words, so well done. Okay, and I'm pleased with your enthusiasm for both short-term and long-term commitment to net zero, and you mentioned Manchester Airport Group. I used to work for a major airline company, and we trialled single-engine taxi and continuous descent approaches at Heathrow Airport, and it's now the norm across most of Europe. Okay, so people are working behind the scenes to reduce carbon, and it's nice to see that you've got passion and commitment. Thank you.
Okay, so I think, Harry, you're carrying on now? Yeah.
Thank you. Yes, and this brings us into a nice segue into the next section, which is indeed focusing on ESG and our commitment to net zero by 2050. And as previously discussed, our commitment to reducing carbon emissions by 40% at a minimum by the end of 2030 as well. Just on slide 15, just to draw out some key points for this slide. This slide predominantly pictures IFM's position within our peer group when discussing these commitments, these discussion areas with our peers in the industry. Firstly, IFM is one of those founding partners in the Net Zero Asset Managers Initiative. It allows us to, of course, access our peers when discussing these commitments, but also allows us to bring that agenda forward as well when pushing towards these targets that we've set. As of today, that's now a peer group of 220 asset managers across the world that we're plugged into. The other quick point I'd like to mention on this slide is the UNPRI. We've been a signatory for many years. They take a good view of us. They rate us on a yearly basis, and on the most recent review, we were graded A+ at a firm level, but also A+ at an infrastructure level as well by that organisation. Just turning to the next slide very quickly, some key points we've already touched on through the questions and answers, but also just previously in the presentation, we've talked about the commitments to net zero and 40% by 2030. That's indeed impacted our investment processes. As Phelim mentioned, much of that has flowed through to our asset management initiatives, whether it's de-risking those future cash flows, bringing in renewables at the behind the meter level, but also bringing that in at a platform level as well. Another thing worth mentioning very quickly is on green financing. So since the inception of the fund, we've issued more than 700 million USD in green financing. So some external validation of some of those projects that we're working on at the portfolio company level with a green objective in mind. With that, I turn back to Phelim for the next slide.
So we just wanted to talk a little bit, and I think we've brought some of this out in some of the questions, but sitting behind everything that we do is we view ourselves as a long-term responsible owner. I think that the heritage that we have coming from a pension fund and a workers heritage really has lent that to be part of philosophy, and I think a lot of what we're doing is a further expression of that. So our goal is to manage the assets that we have and transition them towards a low carbon future to make sure that they are suitable and they can work in this lower carbon economy that we expect. We've mentioned the amount of greenhouse gases that we want to get out of the portfolio, how we embed climate change into our asset management processes. As Harry said, we have what we would call improved or enhanced our investment processes. When we're looking to invest in a company, we need to be able to fully understand and map out what that decarbonisation pathway is. And also something that Harry will be talking to in a moment, we also need to be able to ensure that we have the right tools in place to extract the data that we need to be able to extract, so that first of all we can measure ourselves, but also that you can measure what we're doing and that we can report accurately to you. So some enhancements in the process that we have there, some restrictions around coal and facilitating further upstream oil and gas productions. So we brought in some red lines into the portfolio. They weren't red lines before, they were always things that were there, but we've really wanted to codify those for investors so investors can have more comfort about that. And then we will also look at potentially pursuing further climate related investments and potentially in a new product, and that is something that we will be looking at later on this year as something complementary to the Global Infrastructure Fund, but specifically focused with a narrow remit on the green energy transition. Slide 18 just graphically demonstrates what we're, sorry.
Ask, on the green and the carbon, do you use carbon capture credits, or are all investments purely on reducing the carbon? You don't offset carbon capture against it? Yeah.
So at the moment, we are doing some offsets, but the goal is to move away from offsets. You know, for example, within the Manchester Airports group, they are carbon neutral, but there is offsets currently being used. We are bringing more, obviously we are in the UK, but we are bringing more solar and wind in, and also then looking at where, when we don't have sufficient production, where we can potentially source that production on a green energy basis rather than necessarily an offsetting basis. So very, very much a focus on removing those offsets. So the 2030 commitment, that 40%, is a net 40%, not a, should we say, a gross 40% that you've used carbon offsets to do. Specifically, actually on carbon capture, we have and are investigating carbon capture investment solutions within some of our portfolio companies, because we can, in these bigger, particular energy companies, begin to experiment in very small bite sizes with some of these technologies. There's quite an attractive subsidy regime in the US for carbon capture at the moment. So that's something that we're investigating then as a specific technology, especially with something like hydrogen. How can we capture the carbon from non-green hydrogen production and then be able to, in essence, make that hydrogen green? That is something that we're working on and experimenting with at the moment. I think slide 18 is fairly self-explanatory. It's just graphically explaining what we're going to do. And also I think we've spoken about the various different asset management initiatives that we would have to make that happen. I think that's slide 19. I think questions have already brought slide 19 quite strongly to life. We discussed the Buckeye example where we're bringing in what we call behind the meter solar projects. In other words, as I said, rather than buying renewables directly as kind of, shall we say, naked within the portfolio, but actually building them into our portfolio companies. For us, we believe it's a lower risk way of doing it, and it gives you both access to higher returns, greater energy security within our assets, which is something that's important at the moment. But also by reducing and changing the carbon profile of the companies, we will make those companies more valuable. So we think it's something that's very beneficial. And then 1H2 and Swift Current Energy, they're two examples of, as I've just mentioned to Councillor Graham, of these initiatives that we're bringing into the infrastructure portfolio within our companies, where we're experimenting with hydrogen fuels, where we're experimenting with battery storage, and not just the technology, but also the contracting that you can put around these technologies, because it's all well and good to have the technology, but as an infrastructure fund, we also need to have the right revenue profile around those technologies. So basically making the engineering side and the financial side work, and that's where a lot of the work that we're doing at the moment. Manchester Airports Group also with Mr. Lawrence, we've also kind of talked through those particular points, I think, in quite a lot of detail. So in the interests of time, I'll take those as read, if that's okay. I'll hand back to Harry just to talk briefly about climate change reporting, because it is something that's obviously quite a focus of the regulator, and helpful to hear what we're up to.
Thank you, Phelim. Yes, so of course, we've been discussing some of the strategies we've been employing to reduce carbon, but equally as important to report on that is something that we are very focused on. So on the slide 20, there's three main reports that you'll see there that we release on an annual basis. First of those is the carbon footprint report. That is a company-wide report. It talks about that is a GIF. The fund-related report. It measures the carbon footprint of the fund on an annual basis, and that is something that we release to all of our investors. The responsible business report is another report we do annually that looks at the corporate-wide strategy that we employ, whether it's at the corporate level, but also across all the different asset classes that we manage across IFM. And then finally, there is the TCFD report, or otherwise known as the climate change report. So again, looking at some of those risk management tools that we employ when it comes to ESG, the data that we capture there is very much in sync with TCFD guidelines, and is again done on an annual basis, and something that we do release to investors as well. Now, we shared these reports prior to the meeting, but we're of course very happy to reshare and go through those in further detail as well. We're very conscious of upcoming regulations, especially here in the UK. There will be increased scrutiny when it comes to producing the data and releasing the reports in the future, and we're very much ready to make sure that that data is captured effectively and transmitted accordingly to all of our investors. That ends this chapter. Before I turn to the next page, shall we pause for questions?
Foolish.
Can I ask a quick question regarding your choice of a 40% reduction by 2030 and why you chose 2019 as your base year?
So the 40% reduction is based on a 1.5 degree Paris-aligned scenario, and in essence running that from 2019, which is when we had the portfolio pretty much as it is at the moment. If we ran it from 2018, we wouldn't have had Buckeye in the portfolio, and that's a very, very large, and it's an emitting piece of the portfolio. So 2019 was, in our view, kind of a good baseline for where the portfolio was. And that 40%, if you look at the Europe, I can't remember, forgive me, the exact dates, but if the UK and Europe have two different dates and two different percentages. I think the UK is 75% and Europe is 55%, but the UK is a sort of 75% from 1990 and Europe might be 53% from 2021, 2000. Anyway, as I said, I can't remember the exact dates, but our 40% is very much aligned if you were to run them alongside and calibrate them. So we're very much aligned to those as well. So they're all pretty much aligned to a 1.5 degree scenario. And I would emphasize that the 40% is the minimum, and if we get to 40% by 2028, we're not going to stop and go we're done. So it's very, very much a minimum.
Thank you. Thanks.
Great, thank you. Just turning to the next section, slide 22 on performance. Very quickly running through recent performance of the fund, and also of course for Leicestershire as well specifically. So on the table there you see on the slide, we've set the gross return for the fund on the top row, and then the Leicestershire net returns after fees and expenses on the second row of that table. So just starting with the fund return at the top row, on a since inception basis, which as mentioned is 2004, it has delivered 10.1% on a gross basis in USD terms. Although we have, of course, as you very much aware, seen that short-term disruption over the last couple of years. On a 3, 5, 7 and 10-year basis, the fund has delivered to its target and has delivered those returns you see. On a Leicestershire level, again, as mentioned, we did see that disruption in the last couple of years, specifically at the beginning of 2020, but since then the investment has benefited from that normalization and that stabilization in the portfolio, delivering a 1-year return to the end of December last year of 16.9% on a since inception basis, which in this case is 2013 when Leicestershire was first drawn into the fund. That is 10.1% per annum as well. One of the key point on this slide that we like to draw out is and as Fabian mentioned slightly earlier, is the weighted average leverage figure of 36.1%. As discussed, we believe this figure to be quite conservative. It's measured at the portfolio company level based on each company's valuation in the fund. The debt is predominantly investment grade at long tenors and it's fixed rate, and it has built into that stability that we've seen, the resilience we've seen in the last couple of years throughout this pandemic period. With that, I will turn back to Phelim.
Chair, may I take the COVID and responding to COVID slide perhaps as read, so we can move on to the next section?
That's fine. Thank you.
Because we thought it would be important just to touch on market outlook, and we felt on slide 25 we'd start off with inflation, clearly something that's very topical and front of mind for us all, as you know, particularly as we're all experiencing the effects. I think importantly, the Global Infrastructure Fund has strong inflation, should we say, protection or inflation alignment. The total portfolio level inflation beta basically means our sensitivity to inflation is pretty much 1 for 1. So if there's a 1% rise in inflation, we should see the portfolio's cash flows and underlying revenues increase by 1%. So that means that we shouldn't see a performance impact. Now, clearly, these can be lagging. It's not an exact immediate science. But what I think it can assure you is that there is a lot of portfolio resilience in this portfolio. There's a second aspect to that, which is probably less spoken about, which I think is important, and that is the nature of our client base. 88% of our clients are businesses, 12% of our clients are customers, people like ourselves. From an inflation point of view, that is quite important because our business clients, be it in the airports, be it on the toll roads, be it in our utilities that are using those, that not from an ordinary client point of view are midstream, what we provide is a very, very small part of their total cost basis. So our ability to increase prices within those particular businesses is probably higher and less subject to potential political pressure than we would see on the client side. So I think you've got a lot of inflation protection built in, not just by revenue type, but also by the types of businesses that we face off against and the geographies that we operate in. So I hope reasonable kind of guidance there on the sensitivity of the portfolio and the resilience of the portfolio to inflation. I'll quickly pause there just to see if there's a question on inflation.
Just out of interest, really, is it obviously inflation can have different drivers, supply-led, demand-led, etc. Does that sort of inflation protection vary depending on kind of the source of inflation, or is it kind of all weather?
It's a really good question. I mean, if you look at the businesses that we have, there's input costs, so energy costs will definitely be a driver of that. We're not as necessarily dependent upon goods and services because we're more a mover of goods and services than necessarily somebody who's a recipient of goods and services. So if anything, probably more impactful to us is something like, you know, the ship when it blocks the Suez Canal, or of course COVID, when basically the supply lines start to kind of break down a little bit and we get overloading in one port and underloading in another. So generally speaking, we're not a huge, the input costs of goods are not a huge input cost to us, but probably the one exception to that is renewables. Of course, as we renewabilize our business, we need access to the various different solar panels and turbines, etc., etc. we're getting through that particular potential issue. That's not just an inflationary issue, but that's also a supply issue by aggregating our orders across all our businesses. So our orders just become so large and meaningful to the various different suppliers that we get preferential treatment. Does that answer the question? Yeah, thank you. I would just very, very quickly, because I'm very conscious of time, and Chair, are we okay to?
Yes, please. Yeah, okay. Carry on.
So 6 themes that I think we've touched on some of these already. I think the first theme is that there is a high level of competition in the infrastructure universe. There's a number of new managers. There's a lot more allocations that are going on. We see more sort of, I suppose, you know, more kind of peers coming into that particular space. So there is a high level of competition. With that high level of competition, it's important that we continue to distinguish ourselves. And I think we distinguish ourselves by our approach towards partnerships. So we like working with strategic public sector, semi-state partners. We look to use the fact that we've been operating in infrastructure for 25 years to access perhaps investments that other of our competitors mightn't necessarily come across through those relationships. And of course, the Global Infrastructure Fund is already a large fund. So we use the network of businesses that we have in that to try and, again, source opportunities that wouldn't necessarily be available to peers. Definitely difficult, definitely challenging. The investment team, we all do a lot of work around this, but it is something that we feel that we contend with. Leading from that is about how do you price risk? I think one of the big imponderables, of course, in that or challenges of that has been climate change. And I think we've touched on the enhancements we've made to our process to be able to price and evaluate those risks and take those deliberately. Obviously, the global uncertainty, the war in Ukraine, COVID, you know, these issues, of course, there's something that we reflect on. We have another portfolio system that we use, which allows us to stress the portfolio, take various different views and create various different scenarios so we really understand the next businesses coming into our portfolio. As a business, we have no exposure to Ukraine. We have no exposure to Russia. We've got very, very limited exposure that would be impacted underneath the current situation. But this doesn't put us off investing. Essential infrastructure continues to be very important. It's just about understanding, as we said, the sort of risks that you're taking, being able to calibrate that. I don't want to say too much about regulatory and political risk. They're obviously out there. We look to distinguish ourselves as a pension-owned business representing pension funds. As some people will call it, the acceptable face of sort of private capital as long-term pension capital. And that certainly resonates. And I think also what resonates is our ability to work with the public sector. I think we've touched on ESG and responsible investments already. And then the question that Mr. Lawrence asked as well, technology and disruption can be a benefit to us. So the electrification of cars and the hydrogen maybe of trucks is a net beneficiary to what we do. If there's AI driving cars, we can put more cars on our toll roads and they'll run more safely. Again, potentially a net benefit to what we do. So we are very aware of technological change, and we have a board of senior advisors, one of whom is a professor at MIT who feeds into our analysis of what those potential future changes could be. That leads into an investment pipeline. You know, the deal that Harry has just mentioned, the German fibre deal where we're rolling broadband out to 4 million homes, that fits into technology, it fits into ESG, it also fits into appropriate pricing of risk because we're working with Deutsche Telekom, the most established partner that you can have within Germany if you're rolling that out. So it may be just an example of how some of those themes come into the next transaction, but also beyond that, you can see some other themes that link onto these points up above. And I think importantly, you can see that there continues to be a strong investment pipeline for the portfolio, and we continue to look to add, you know, accretive and sensible opportunities to the fund over time. That was where we were going to finish, and really finish with, again, to echo what Harry said at the start. You were our very first investor in Europe here in the UK. You know, it's been you know, we've had a very, very, you know, strong reception from the UK corporate, public and private markets in the pension fund space thereafter, but we really are, you know, grateful to people around this table for committing to us and giving us that chance.
Thanks very much, Philip and Harry. An excellent presentation, very clear, and I'd say something which is extremely complex. You make it sound simple and understandable to us, so thank you very much. Does anyone have any other questions or comments? No, I think it's excellent. Thank you very much, both of you. So on to the responsible investing update. Bulesh is going to introduce this item. Members will note the representation submitted by Climate Action Leicester and Leicester that have been circulated and published with the agenda. So, Bulesh.
Thank you, Chair. So we've got 4 things to cover off in this paper. We've got the fund's position with respect to direct Russian exposure. As Chair's just mentioned, the fund's response to the Climate Action Leicester and Leicestershire regarding fossil fuel divestment. We've got the 2 standard pieces, which is the quarterly voting report appended as Appendix A, and an update to the progress on the RI plan for 2022. Just clicking over to page 90 and the fund's position with respect to Russian investments. Point 12 is similar to the emails that were circulated earlier in the month. Fund has identified the exposure to Russian and Belarus companies. We contacted a number of the managers and we estimated at the time to have holdings of circa 0.15% or 10 million. Since then, a lot of these valuations would have probably decreased. A lot of the underlying managers have probably marked them down to 0 by now. There'll be some that won't have been marked down. There'll be some holdings within private equity which don't get valued as often, and they'll still exist. But the vast majority of our exposure was via a passive fund, Legal and General, which hugs the benchmark and therefore has to hold certain funds, and Central's emerging equity fund also. A lot of the managers that we did contact pretty much said they held no Russian exposure, didn't intend to or couldn't for various reasons based on the mandates. 17, 18 and 19 talks about the importance of ESG. We'll just have a quick look through 17. So looking through the ESG lens further highlights the unattractiveness with free press suppression, the heightened risks of owning local physical assets in Russia, the uncertainty of the economic performance now with the ongoing war, foreign exchange risk with the ruble bouncing around, and also, Russian banks subject to capital controls makes Russia not very appealing to managers. So there's another reason there not to hold it. We have asked a lot of our managers when it's appropriate to sell down. You'll have heard from other LGPS funds of a similar stance to ourselves, using ESG as the basis for not wanting to hold any Russian assets. There is a desire to exit positions as soon as possible. However, Russia have kind of stopped that and put blocks in certain cases, not being able to sell, markets being closed, not being able to exit your money when sold. So there might be a period of time where, the money is just kind of locked up there. And in the case of private equity, it'd be a bit longer to be able to sell out just because of the kind of nature of having to sell in private markets and the lack of buyers at this current time. Like I said before, the position is in line with public statements of other LGBS funds, and in line with the correspondence from the Secretary of State for levelling up housing and communities. We did send in an update to employers via a portal. We also sent out emails to both committee chairs and the board as well. Future decisions for the fund might not be as straightforward, where there is public concern but a less coherent government response or global government response. The fund will need to consider the changing geopolitical landscape over the course of the year. We do have an equity review upcoming later this year as part of the SAA, so we'll probably tie those 2 things together to understand the kind of increasing geopolitical risk and whether or not our holdings across the globe are adequately diversified. The second point of this paper, the fund's response to Climate Action Leicester and Leicestershire. We received a representation from Climate Action Leicester and Leicestershire regarding divesting from fossil fuels, stating in the light of urgent need for the world to reduce its carbon emissions sufficiently by 2030 to prevent catastrophic climate change. They've asked the following: cease to make new investments in the top 200 publicly traded fossil fuel companies. divest from direct ownership and of any commingled funds that include fossil fuel public equities and corporate bonds within 5 years, and to make a public statement to divest from fossil fuel companies, giving a date by which you commit to be fully divested, and calling for national and international regulation of the fossil fuel industry to ensure the world remains below 1.5 degrees of global heating. Turning over to page 92, these requests are broadly an engage versus divest debate. They will be considered as part of the drafting of the net zero climate change strategy, which will come later to the committee in the year. 26, 27 and 28 I think are quite important. There are many ways that the fund could reduce its carbon emissions, and so focusing on a portion of the fund, i.e. fossil fuel companies, is not the only solution to a wider problem. In fact, it can be argued that some industries have a higher carbon footprint, and it's with this in mind that the IIGCC framework that we're using for our strategy intends to address the achievement of net zero by an overall reduction across many asset classes and over time. Our own fund's climate risk report highlighted a number of companies that contribute the most to the total carbon footprint of the fund. The largest contributor to our fund is a power utility company, but it's also the largest wind and solar renewable energy generators. Other companies in the top 5 included material manufacturing companies, which include cement and a semiconductor manufacturing company. As a reminder, the current view of the fund is that it does not see divestment from carbon intensive companies such as fossil fuel companies as the best way to manage climate risk. Divestment has no impact on the world's carbon footprint, and in some cases divesting will remove green investment exposure from the fund. The third part of this paper is the update on the quarterly voting report. It is appended to the report, and just to remind you, it covers the period from October to December 21, and it covers the equity investments that the fund holds with LGIM, LGPS Central, and it covers about 46% of the fund currently. Just to remind you, about 23% of the fund can't be measured in the same way. You know, it's invested in commodity futures, currency forwards, derivative contracts, property, etc. Turning over to page 93. We've got an update on this year's 2022 RI plan. Pleased to say it's largely in line. We've got all the elements completed for Q4 with a workshop climate strategy to come. I'm happy to take any questions at this point.
Thank you, Bush. Have we got any questions? No. Oh, yeah, Adam.
Yeah, thank you for the report. I'm intrigued by the statement that divestment has no impact on the world's carbon footprint. There's no source for that statement, and that is contested. In my reading, it's certainly a contested statement. And you say it's the view of the fund. So it would be useful to have the source, and it would also, I think it would be useful to me to have the in the round debate around this, rather than something that's put to me as fact in a statement without any evidence or source.
Okay, so yes, we can cover that off, and I think we've got specific elements within the climate strategy to pick up that further. I think what we were getting there was when we divest from the fund, somebody else still has to buy that asset, and in that respect, Shell, for example, doesn't reduce the kind of carbon that it emits.
If you take our action in isolation, but our actions also have consequences in terms of impact as well, and I think you have to recognise that somebody has to lead here. So I think the consequences of our actions may well be that Shell does, if there are others that take the same actions.
I take your point, and I think it's a valid debate, and I think we've got a specific element within the strategy to address that. So we'll have I think we might have an external do some work on that and include it within propose for a strategy.
Thank you, Bhuvesh. So the strategy will address that point.
Yes.
Yeah, thanks very much. Mr. Lawrence.
I think Mr. Clark's got his open still.
Yeah, I'm on now. Thank you. I just on the related point to that. It seems to me that my challenge to the voting members of this committee would be, please listen to the voice of those academics now who are providing evidence to suggest that engagement may not be as effective as this particular fund currently thinks it is. That divestment actually is a valid option to be considering, and if there is that evidence coming through now from academics that could have a beneficial impact in actually a more effective fashion than engagement might have been in the past, might have thought to be in the past. So I just really have, on behalf of scheme members, many of the scheme members I think would feel the same way as I would about that. So I would ask the voting members of this committee to be open to that information, and that is included. I think it's referred to in the climate action Leicestershire submission to you.
Yeah, it is included with that. So all members have read that. So.
Thank you very much, Chair. Because I'm new to this committee, and I'm not fully familiar with all the methods or indeed past decisions. I'm assuming that paragraph 28 refers to a decision made at a previous point around the current view of the fund does not see divestment from carbon intensive companies as the best way to manage climate change risk. So I'm assuming that the world may have changed since that decision was made, and when we come to examine the development of our strategy, it's something of course we should be able to have a look at. And it was about the preparation of the strategy that I wanted to ask you about, Chair. There is a workshop in the plan, which it says due March 2022. That's this month. I'm assuming that may have been delayed a bit. Is that something that we will be all invited to attend, or how will the strategy be developed? Will we receive a draft? I mean, we did at the last meeting, I believe, have 3 different pension funds climate strategies to have a look at. Now there may be more than 3. We may want to look at other local authorities that were not included in those 3. So I'm just trying to understand the process by which the strategy will be developed, whether we will receive further information from perhaps other local authorities, the academic research referred to by my colleague here, and indeed any other further information. Thank you, Chair.
Thank you, Chair. I mean, I think the papers that were sent out with the committee meeting actually references lots of academic studies and links to them, so we have got that information. Bullish, our climate strategy, where are we going with that?
So, in coming back to the March reference, we can do that. I think we're planning to end today. I believe there's adequate time to do that after the end of the committee, so we will pick that up. You also talked about where we included 2 or 3 previously, but we've also had a look at all the climate strategies that are available within our pool, so within the central pool, which we're one of 8 of, so we can expand on that.
Okay, thanks very much, Bhuvesh. So any other further points? There's certainly plenty of reading on climate change that was sent out, and both sides of the argument are presented. So,
sorry, are we just looking at the central pool, or are we looking at more broadly?
I've looked at the central pool to date. It's I speak to my colleagues there regularly on a monthly basis, sometimes weekly. So I can tap into their information a lot easier.
But just as a general point, we can look wider at things. I'm just conscious we're in danger of having the debate here and then having the workshop after the session and almost kind of exhausting myself. But you're right, it's kind of the central's not the only sort of piece in the world.
Thank you very much. Thanks, Adam. All right, so do we have any other further questions? No, we are asked to note the update received. So the next item is the business plan and budget 2022-23. Declan Keegan is going to introduce this item.
Okay, thank you, Chair. Hopefully it's a fairly straightforward report, so I won't sort of spend too long on it. And it brings together, I suppose, the financial kind of the costs, as it were, of the kind of both the investment side and the administration side. And the key point, I suppose, to know is a theme running through the administration side is very much that kind of regulatory influence, where you'll see kind of McLeod costs and pension dashboard costs are sort of two of the sort of the main themes, both driving the work of kind of Ian's team, but also kind of some of the extra costs in the pension fund, which obviously kind of Councillor Merry kind of picked up earlier as well. And it is, even if you look past previous years, it does tend to be the fact of life that local sort of influences are kind of in some ways secondary to actually what the regulatory environment is out there and what those pressures it does put on us. In terms of the investment side, it's one of those, we include it, and it is good practice to include a budget, but it's not impossible to actually estimate what those investment costs are going to be, because they're intrinsically linked to actually the performance of the fund, which again, there's a huge amount of external influences, and particularly as we're transitioning assets into central, although it's kind of looking positive on that kind of medium-term basis as our management costs reduce, actually things like transaction costs do go up quite a bit as you kind of buy into and sort of sell out of positions. And just sort of touching on central, every transfer we've made now to central has been a positive cost or a cost reduction that's sort of been positive for the fund. So that is still looking very good for us. And we've also seen, I mean, the infrastructure manager touched on it before, we are starting to see an increasingly positive kind of attitude to fees, even for kind of investments we're making outside of the central pool. You know, things like aggregation across LGPS was the way a lot of managers started to try and kind of counter the kind of the raise or the implementation of the pool. So we are seeing that kind of positive impact even outside the pool as well. One area I did want to pick out is this sort of cash flow forecast, which is down on paragraph 26, which we haven't tended to include too much, but it's increasingly important that we do. And you'll see that the forecast opening cash of 180 million, which is slightly different to a paper you'll see later in the agenda. But this is just a forecast for the end of the year. Obviously, a bit of a guess. And you'll see that kind of the desire to get that position down. The pressure for the fund is upward in terms of cash. We've got investment income coming back, and we're cash flow positive, which is the money coming in from employees and employers are exceeding the level of pensions that we're having to pay out. So there's quite a bit of sort of new investment activity that we will need to make, and most of that has been put in train already for decisions made, but we will over the course of the year have a few more decisions to make to just keep getting sort of the money away and invested to hopefully get that cash position down from just shy of 200 million to hopefully below 100 million pounds. That's all the elements I was going to bring out. Happy to take any questions or comments.
Thank you. Thanks, Declan. Has anybody got any questions or queries on the business plan? No. So we are asked to approve the budget for 22-23 and the administration and investments business plan. Is that agreed? Yep. That's unanimous then. The next item we have is the risk management and internal controls, and I will ask Bulash to introduce that.
Thanks, Chair. Purpose is to inform the committee of any changes relating to risk management, internal controls of the pension fund. The risk register has been reviewed following suggested best practice of the fund's advisor, Hymans Robertson. As a result, risks have now been split into 6 different areas. The risk areas are investment risk, liability risk, employee risk, governance risk, operational risk, and regulatory risk. It's been appended to the report. We've got 7 changes from the last report. I'll just go through a couple of them very quickly. Risk 3 investments, failure to take account of all risks to future investment returns within the setting of asset allocation policy. We've increased that risk whilst we're setting a climate strategy. Number 9, governance subfunds are the individual employees that are not monitored to ensure there's correct balance between risk to the fund and fair treatment. Again, and residual risk has increased while fund officers assess the employee's fund risk as part of the fund valuation. As part of best practice, the register has been shared with internal audit, and internal audit have considered the register and are satisfied with the current position.
Thank you, Bulash. Does anybody have any questions? No? Okay. We are asked to approve the revised risk register. Is that agreed? Yeah. Thanks very much. So again, we are now on to the training policy refresh. Again, Bulash, can I ask you to introduce this item?
Thank you. The purpose is to seek committee's approval of the revised training policy. The board endorsed it at the February meeting. Just a reminder that the training policy was first agreed in November 19 by the pension committee. It's been refreshed, and like I said, it's been taken to the board on the 16th of February. The board and committee members are asked to complete training needs assessments on a yearly basis. The results, together with the current priorities of the fund, are used to decide on the approach and topics of the training offered. Some of the things that we offer are some face-to-face sessions internally delivered by officers, the actuaries, investment managers like we saw from Ifm a moment ago. We've got recommended reading material that we can send out, and then we've also got really good modules from the Hyman's online training package. Also, we offer induction training to any new members, committee and board, and I extend that again. If there's any additional help anybody needs, then feel free to get in contact. There is also an information pack which is sent to the committee. It's the contents are shown on table 9 there. And on point 11, we can see the 6 modules which are currently available.
The information pack.
Yes.
Virtual one. I didn't seem to have.
There was a printed pack some time ago, and there is a PDF version, I believe, as well, Kat. Is that correct? Oh. No, I think we're confused here. I think the information pack you're talking about is the folder of. Oh, it's okay. So it's okay.
Could I have a physical one?
Print another one off.
Very bad at virtual.
Yeah, I think we did have one about.
But I see.
yeah, no,
I don't know where it is. But
no. Of course, we'll get you another one.
Yeah,
all right. Does anyone have any comments or questions on the training policy? Also got access, I think, to Hyman's training policy. So there's 6 modules there which are useful. So if no one has any questions, we're asked to agree the revised training policy. Is that agreed? Yep. Thank you. So the next item is the summary evaluation of the pension fund investments. I'll ask Declan to introduce this item.
Thank you, Chair. Obviously, this report runs to the end of December, and kind of, you know, it's not drastically out, but it's sort of a slightly false picture. Even before the sort of the Ukraine sort of incident sort of happened, the equity markets were starting to kind of go south a little bit, particularly kind of sort of the technology stock. So just bear that in mind. That is this just does run to the end of December. At the moment, it's kind of in terms of the sort of scheme of volatility that we do see over kind of sort of financial markets, if you look back sort of like the last 5, 10, sort of 15 years, it is still at sort of the relatively kind of small type of impact. But obviously, the kind of the longer the situation in Ukraine goes on, and the sort of the increase in sort of sanctions and the decoupling of kind of Russia, etc., will increase the potential impact. But obviously, the diversification of the fund does help an awful lot with managing this risk and creating a bit of a balancing. We're not particularly heavy into sort of one sector as a fund. So that diversification has been really key for us. So I'll just pick out some of the main points from the report. We've got go down to sort of paragraph 13, the portfolio changes. Just to update those changes, I've been instructed of the managers there. The instruction for the multi-asset credit funds, £29 million, is just to correct a sort of an underweight position, and the Aegon 60 million is just a sort of a holding position while wait for other calls to be made or other new investments to be identified. Next one I was going to pick out was paragraph 15, which is kind of quite a nice example of that diversification. There's obviously kind of the NASDAQ, the sort of the new world kind of technologies has kind of taken a bit of a hammering, particularly in sort of January, but sort of the FTSE, which is obviously seen as very much the sort of the old world kind of industrial type things, has created a balance to that, and that's not something necessarily kind of anybody was saying was that's definitely going to happen as we turn from 2021 to 22. Actually, that's just the benefit of having a sort of a quite a well diversified fund. Paragraph 18 onwards, the cash position. Again, you see that sort of £200 million, which is a shade higher than what we were forecasting for the end of the year. And it just kind of it just gives quite a good forward look of where we're going to sort of take the what we're going to do with that sort of investment position and where the sort of the cash is going to go. So it's worth having a bit of a look at that. And coupled with paragraphs sort of 23 and 24, which does just look ahead of the things to expect coming up. The property review is likely to be the first ones. We've got kind of it's probably a more complicated setup than we need with kind of we've got assets held with Colliers, with sort of LaSalle, and we've got I've forgotten what it's called, Aegon as well, but also sort of Central now starting to sort of develop products. So we've got quite a sort of a messy setup that hopefully that property review will start to detangle a bit, but worth having a look at those paragraphs just to give you a sense of what's going to be coming up. And then the final thing I was just going to highlight is paragraph 28, just gives you that performance of the fund. And again, it's kind of this, you will see sort of a bit of a drop off as we look at this in the next quarter. But if we're thinking ahead to the valuation, we only normally kind of aim for about sort of a 5% return. So if you see the sort of 3-year figure of 11%, there's quite a bit of buffer there before we start to get into kind of, I suppose, worrying about the valuation necessarily on the investment side of things. It is likely, and Hyman's touched on it, that the future investment returns are going to see us be suppressed as kind of the global GDP sort of estimates are kind of they're just sort of tumbling at the moment. It's sort of quite a drastic rate. So if people watch the Chancellor's spring statement, I think we've gone from a 6% growth and it's kind of more than halved that. So that's going to be happening around the world. So it is concern on those future returns, but we have got a bit of a buffer and we do take kind of a prudent kind of view as we do set those valuations. So that's all I was going to pick up, Chair. Happy to take any questions.
Thank you, Declan. Has anybody got any questions or queries on that report? No. So we're asked to simply note this report. Is everybody happy with that? Yeah. Thank you. So I move that in accordance with the Local Government Act 1972, the public be excluded from the meeting for the remaining items of business on the grounds that they involve the likely disclosure of exempt information. Can I have a second? Thank you. All those in favour? Yeah, that's everybody. So, Kat, just if you tell us when the live streaming is finished.